How's it going? Welcome back. It's Jonathan. In this video, I'm going to be talking about Bitcoin and primarily Bitcoin. Now, the reason why we're going to be focusing on Bitcoin right now and into the end of the year is because of the reason that we are coming up into what could be the end of the Bitcoin cycle. And I would hope that if I or anyone else could give you any form of support, it would be on how to best operate in the markets as we end or come into the end of this market cycle. Now, there's a few points that people are starting to bring up right now, and they're starting to put out price forecasts. Some people are saying $100,000, some people are saying 150, some people have gone out to around $250 mark for the BTC cycle. We've also got other people coming out that are saying that this time is different, that the cycle is going to lengthen, that we could be going to $1 million, that the crash that's potential at the end of the cycle isn't going to occur. There's varying ranges of hypotheses that are being thrown out right now, and I wanted to come in just with my angle and give you an idea on what I'm looking at and why I think that potentially this time could be different, but it's not going to be as different as to what we're assuming. No doubt we know that countries are getting on board with Bitcoin. We know that ETFs are coming out for Bitcoin. We know that investors, managed funds, etc., they're all jumping into Bitcoin, and these whales are buying up the market, and there's no way in hell that these whales are ever going to lose, right? And what that means is when the Bitcoin market crashes, these whales are going to pretty much support the market, and they're going to keep buying at a lower price. That's the hypothesis. But you have to remember that these whales, and I'm going to, put little markers around the word whales because they're just people with money. So you can't term people with money with the word whale just because they're richer than you. These people, they're not in the market to try and protect you from a crash. They're in the market to make money, okay? So when a managed fund goes out and they buy companies, let's say a few Australian ones like Telstra, Commonwealth Bank, NAB, Westpac, ANZ, any of these banks on the Australian Stock Exchange, just to give you a long history of how this works. These hedge funds, these managed funds, these ETFs, or I shouldn't say ETFs, money managers I should say, they generally don't lose. Generally they don't lose, which means that when the markets crash or when it's already bottomed out, they've either already sold their position or they're looking to redeploy more money lower on. Now let's take, for example, the 2020 coronavirus crash. If whales, if managed funds, if money managers were so big and powerful, then why did the market fall around 45%, depending on which country you're in 2020? Surely the market should have just fallen 5% because the whales were going to buy it up, or surely it would have just fallen 10%. Why did it fall between 30 to 50% depending on what country you're in? Now that's what I want you to think about, because it doesn't matter if it's 1929, yes, rich people existed back in 1929, it doesn't matter if it's the 1950s, it doesn't matter if it was 1987, 1990, 2008, 2015, 2016, 2018, 2020, 2022, 2025. The point I'm trying to get at is it doesn't matter. People jump in and they jump out of the markets, and they're not here to protect you, they're here to make money. So you either believe that this time is different, and potentially it could be, and ride the market cycle thinking that the market's going to go to $1 million, or you play it smart and you take your money out near the end of what would normally be a market cycle or a potential extended market cycle. And extending market cycles generally range potentially for the Bitcoin market, maybe another 4 months, okay? 4 months either side. I think is a fair extension for this kind of market. Now again, it doesn't matter if you're a country, it doesn't matter if you're a managed fund, it doesn't matter if what you believe is going to be this time is mass adoption, this time is different. The point of this game is to make money. The point of investing into gold and silver, yes, there are traders in that market. It doesn't matter if it's uranium, iron ore, shares of companies. The aim of the game is to make money. It's not to buy and hold for long term and retire a multi-trillionaire. That's not the aim of the game, and that's not what countries are looking for. So the point I'm trying to get at is it doesn't matter what you believe. It doesn't matter if you believe that this time is different or this time is not different. What you believe is irrelevant to the grand scheme. What you need to know is time cycles, when is a good time to buy and sell, and what are you doing about it. So to sum it up, whales don't matter as much as you think they do. Countries don't matter as much as you think they do. The ETFs that are coming out don't matter as much as you think they do. They're not going to change the dynamic that's at play by a large amount. If there is an inherent cycle, and of course the Bitcoin cycle is relatively new, so we don't know if it is ingrained into it in terms of price points. So we're just going to go on the hypothesis that it is. But if there is an inherent cycle, a cycle that would continue to play out, it is very hard to change that cycle. The only way it can change that cycle is if the whole dynamic of the underlying structure of the market changes. So that is why I put my basis on that the market cycle is going to repeat, and it will continue to repeat until it proves us wrong. And that's what we need to go on. It needs to prove us wrong before we change our angle, okay? So I'm just going to go through the charts again. I just wanted to put that out there first of all because I think it's important to squash any idea that you have that the market cycle is going to continue indefinitely and that you're going to come into halfway point of 2022 a multi-millionaire, because the chance of that gets smaller and smaller the higher the Bitcoin price goes, okay? So let's talk about some points. Now I'm not going to talk about in these videos how far down, if the market is going to correct, how far down it will go, because that's a topic for a different forum. But I will go into the points on what's happening today and what's happening on a micro scale, because I think that's what's important to you. That's probably what you want to see, is what's happening now and how can you navigate that. If I'm wrong, just leave it in the comments and I'll change tune. So let's go ahead and zoom in and take a look. So first of all, nothing much is changing on this chart. This is the daily chart for Bitcoin. This was the golden cross, and we had our death cross, over here. As we know, these two are really irrelevant crosses. People just watch them because they try to, buy and sell using lagging indicators. On the weekly chart, we're still pitching higher. We did break a new high that we haven't been able to close above the April high. So that is something that we should be keeping a close eye on. Now that high is around 64,859 based on the data I have, though based on other data it might be slightly different, but we haven't been able to close above that. So we need to just keep watching, okay? Monthly chart, again, we're opening and closing where we were last month. I'm telling you the obvious right now, but we'll just keep moving on. The swing charts, the weekly is pointing up and the daily is pointing down. Again, I'm going to call the daily irrelevant for now because it could easily just swing back up. We'll see. The weekly chart is still swinging up. The Kagi chart is still posting a higher high by the looks of it. Yes, a higher high. So it's still relatively bullish in this instance. The daily Kagi chart is pointing down, but it's still green, so it could change up, so we just need to keep watching that one. Regarding price, so this is where we were last time. Now if you didn't catch the last video, just go ahead and watch it. There's a lot of golden nuggets. So the last hypothesis was this: the market was going to come down into this box around the 28th. It was going to move up into an early month signal, and then it was going to move down into around the 6th, which was the 5th, the 7th, so around the 6th, okay? That was the hypothesis, and that is what has actually occurred. Now, we can't say that it's actually occurred just yet, and the reason for that, yes, so whilst we have posted a higher move here, the reason for that is because we haven't got another green bar, so we can't yet confirm that the market's not just going to close here and then move straight down. So we just need to be patient. We don't want to run it. If you were looking for the market to potentially buy, yes, you could place buy orders in the market and set tight stop losses, okay? Now, if this was your first trade ever, you could have put a tight stop loss below it if you're looking to trade daily. Though if you are looking to add to your positions and do the whole dollar cost average, buy the dip, etc., I show you exactly how that's done, and that's to buy the lows of these moves, okay? So as the market comes down, you're looking for the market to start to run higher. Once it starts to run higher, you sort of just buy into the market. And you wouldn't really set a tight stop loss here because you've got a buy that issued right here. So if we're looking for price measures, we're currently about 6% away from that. So if the market did fall, you would just move back down into your last price point, though it'd be up to you then to decide where you would trigger your stop loss, okay? Now in this instance, if I was to be looking to buy each dip for the long run, especially on the Bitcoin market, I would have a stop loss of at least 15% because it is quite volatile. So if I was to be buying here, for example, then I would look at my stop loss of at least 15%, which would put it down to around the 49,000 mark. And then that means anything that I'm buying along the way, any dips, would sort of move that stop loss up. So let's go ahead and do another 15%. So this is kind of like a trailing stop, so to speak. So now our trailing stop would be at 51,000. So we've bought down here, had to stop at 49. We bought here, and now our portfolio stop is at 51,000, okay? So we'll just be using some form of trailing stop, but that's just an idea. It's just to give you an understanding of what options you have to you. So that's where it's at. So we've moved down, we've moved up, we've moved down. Now I'm looking for the market to move higher. Again, I can't confirm just yet because it's a bit too early in the bar, But I'm looking for the market to move higher, maybe until between the 10th to the 12th. I think the hot spot is probably the 12th of the month. Okay, I think that's the hot spot. And we'll see if the market can move up into the 12th, and we'll see what happens then on out. Now I need to stop giving every single turn date. So I'm going to start skipping a few as we go over the next few months, mainly because people have paid for it in the link below. So people have accessed this, so I can't just give away this content for free anymore. So I'll start skipping and maybe doing every second to every third time count for you, just so you can start to build an understanding of how this works and how you can actually use it to your advantage. So let's say, for example, the market moves up, just an example this time, into the 12th. What would be your action? Well, if the market's moving up into the 12th and we're using a time count, again, one hypothesis, you wouldn't want to be buying into the 11th, into the 12th, because the probability of a successful trade diminishes, okay? Now there's every chance that the market could just scoot higher straight past the 12th, that's every chance of that, but the probability of success diminishes. The probability of success increases when you move into these lows and you buy the dips, okay? So that's the probability angle. You want to be buying the dips into time counts down, and if you're looking to sell the peaks, you want to be selling, not buying the peaks, okay? So we have to watch the market as it moves. It's a huge topic. I try to just give you a simplified example of it, okay? So this is the Elliott Wave structure. Actually, let's go back to price, okay? So I haven't talked about this much, and I said I would go into it a bit more. This here is a volatility index for the Bitcoin market. Now, a lot of people use the fear and greed index. A lot of people use various other indexes for giving them an idea on when they should be buying or selling. I would like to use, and I have been pointing out to it occasionally, this VIX index and when you should be looking to buy or sell if you were to use this yourself. Now, obviously, all the data that you get in this video, it's already historical information to you, so I wouldn't encourage you to buy or sell on it, okay? So anything I say here is just based for education purposes, and I would encourage you to go in and back test this method yourself, so that way you know how to use it. So when the market gets above, in specific the Bitcoin market, above 45, and this is the target I've set, it is a wise choice to be buying the market. When the market gets to this 25 level, which is another level I've set, it is a wise choice to be looking to dollar cost average into the market and give it like a variance of, say, 5%. Again, a variance of 5%. Obviously, it's stronger when it crosses above them, but a variance of 5%. Now, when the market gets as low as 5, that is a better place and a better way to be selling the market. So let's go ahead and go back in time and see how this has worked. So we'll use this angle right here. Now, let's say, for example, it was 2019 around November time and you wanted to be looking to buy. Well, as the market crossed above the 45 points on this, I'm going to call it a VIX index just for the sake of this, okay? That would have been a low in the market. Now, I know it's a bit small, but there is a low in the market. And then the VIX decreased as the market sort of went higher. And then you could have looked to have been selling into this rally around here. You could have looked to do that. And then this midpoint would be looking to either buy or sell depending on the direction of the market. So if the market's moving up, you want to be selling into the midpoint. If the market's moving down, you want to be buying into the midpoint. In this instance, if you didn't yet sell your whole portfolio, as the market moved up into this portion here, you'd be another sell signal. I usually go a 50% and 100% deleverage, okay? So for example, if I'm looking to buy or sell, I'll generally hit a 100% target in these two areas, the top and the bottom, okay? So the 45 and the 5. And the midpoint here, around 25, I'd be looking to do a 50% portfolio allocation to either the buy or the sell side, okay? So any action happens around here, if you bought in along the way, you'd be looking to de-risk or add risk at a 50% rate. Now let's say, for example, you get the March crash and this happens on the VIX, well, that would be a good buy. The market then rallies up and volatility decreases a lot. You could sell not long after into that rally. Again, let's go forward. Now, like I said before, when it heads into these areas here, you want to manage your portfolio at a risk to reward ratio of 50%. And every time it goes below, you'd be looking to de-risk. And every time it goes above, you'd be looking to add risk, which means buy and sell. So you'd be looking to buy around May 22, also around May 24, and then June 21 to 22 out to June 27. Those are the points in time where you'd want to be adding to the portfolio. Now, as it came down here, if you wanted to buy, so if your bias was to the upside, you wouldn't be doing 100% allocation anymore. So let's say, for example, what I mean by 100% and 50% allocation. Let's say, for example, your dollar cost average $1,000 each time. You might do $1,000 a month, $1,000 every 2 months, etc. Well, when it comes into these areas, you may just decide to put in your whole $1,000. If your bias is that the market is going to be bullish and that you want to buy when it's around these levels, so the 25 points, and you think the market's going to keep moving higher, you can, but you do it at a level that's 50% of your normal allocation, which means that you do $500 every month or $500 every 2 months, whatever your allocation is. And then when it comes down to these levels, you'd be looking to, so let's say, for example, you wanted to sell the market, you'd be looking at selling 100% of your portfolio. So you would have ridden this gain and sold out completely. Now that's just using this theory by itself, okay? So the VIX fix by itself, using it to buy, sell, and allocate half each time. I don't advertise or recommend that you do that. I'm just saying, how would you think and what would be your thought process of doing that? So something to consider. We'll see if we can follow this moving forward. So the lower it gets, the higher the probability of a top, and the higher it gets, the higher probability of a bottom. So as this moves up, generally the market moves down at the same time. Generally, not all the time, but generally, which means that we have a safer place to buy. Now, we are still in the sell territory. Okay, so we still are in the sell territory until this can sort of stage a higher move and we sort of get into the fear angle. We would be looking to remain cautious to the bull side. So how long has it stayed in the sell territory? Well, it can, as we can see, stay there for several months at a time in a bull run. So it can stay there several months at a time in a bull run, and we generally want to be allocating massively when it gets up there. So I'm not saying now that we're at the top. I'm just saying that this is the situation that we're at now, which would mean that we'd be looking to allocate half of our positions because we could be nearing a potential top in the market, which could last weeks to months, okay? So yeah, I'm just saying, don't have $100,000 and don't put $100,000 in today. If that's your life savings, don't do it. You might be best off putting $10,000 in, $10,000 in, $10,000 in, and then eventually cashing out once we get to an eventual peak. It's just about money management and risk to reward, okay? So just, yeah, thought I'd mention that. So Elliott Wave, we're still potentially in a third wave for the Elliott Wave, and that is also in a longer term fifth wave, okay? So there's something to keep in mind. We're still on track, nothing's changed. Bitcoin cycles, so the cycle's now played out. So this cycle has now played out. We did get our low, which coincided with this cycle down here. Let me go ahead and extend it. So we got sort of a dual cycle playing out, which means that these two cycles have now, by the looks of it, moved into one, with our starting point being here. So I'm just going to grab this now, and we're going to reset the cycle, and we're going to start it from here. And that would give us a potential left or right translation for December with a potential higher or lower low. Let's go ahead and find that. Where to go? Lost it. Higher or lower low towards the end of January. So starting from mid-January going out to February. So we'll have to see what happens there, but we're getting a potential higher or lower low for January. And that'll give us clues in December if we get a peak to the left or the right of this one right here. So that's going to be pretty interesting. We'll have to see how that plays out, and I'll keep watching that. So now we're now in November, and this is pretty interesting. So we're now in November. Now if we look at where we are in November, let me go ahead and see if I got the latest data for this. Good. We are at the very low end of where we could be potentially for November. So if November is of any significance, we have around 25 days left of the month, and if it's of any significance, we could get a huge rally. So that is going to be very exciting. I'm not gonna say that it's definitely going to happen. We're off to a very, very, very slow start right now, but there is every potential that this rally could be coming, and we could be coming quickly. So let's go ahead and take a look at, I'm going to go back to the daily chart, because what I want to see is I want to see what happened in 2017 to see if we can get any clues. Okay, so in 2017, we sort of got this start of the month of nothingness, where the market just did nothing for the start of the month. And it wasn't until the 20th that the market started to rally. So every potential there. Let's go back to 2013. Where are we? 2015. 2015 saw a start of the month sort of decline before an end of month into December rally. Let's keep going back. 2013, we saw a start of the month pretty much doing nothing, maybe a slight decline in the start of the month before an end of the month rally. Okay, so given that, and just some, random months I've chosen for November, based on where we are in the cycle right now, there is every potential that we could be getting a nothingness for at least another week, maybe a week and a half. We could be, I'm not saying that it's definite, but we might be containing in this area here until maybe mid-month before we start to move off. So let's see what happens around the 12th, and then maybe we might get a dip into maybe the 18th or so, maybe the 15th to the 18th, before we sort of start to stage a higher run. So let's go ahead and see what happens. That's going to be very interesting and something that I just wanted to point out while we're here. Now, the only other chart that I wanted to show you today, which was the square of 9 chart. Now, if you haven't been watching the square of 9 chart, I'm not going to go into it today, but there is one thing I wanted to point out, and that is potential significant resistance around the 63,000, maybe 63,100 mark. And that is because this 45-degree angle has hit tops multiple times. So the market sort of tried to rally higher and fallen, rallying higher, fallen. So there is a very significant resistance here. Now you might be saying, oh look, Jono, it moved above it. Yeah, that's cool. But what didn't happen, what hasn't happened except for 3 bars, or 2 bars I should say, this bar here and this bar here, is that for the remainder of this period here, we never closed above it, okay? So for 2 bars, we closed above it. All these bars here, we sort of get to close just below it, okay? So that's, in my opinion, a very significant level here. And what I would like to see is a strong close above it before, and maybe a touch on it, before I can suggest that this 45-degree angle has played out and we're now moving forward. Likewise, this 45-degree angle around the 60,000 mark has provided a lot of support to the downside. So to any down move, it's also going to be a significant level to watch. If the market does go up into maybe the 12th, comes back down, now it could touch it again, or it could touch a higher one. That's something interesting, something I wanted to point out, and definitely something we should be watching, because once it gets above this and it closes, you know, the game has changed, the tune has changed, okay? So that's what I wanted to say. Now, just to wrap up again, we've spoken about the whales, we've spoken about ETFs and managed funds and how this time is different. I'm going to come out here and say I don't think this time is going to be that different, because the more people that think it's different, the less likely it is that it's going to be different. And that's the beauty of it. Everyone thought that in 2017, everything was going to be different. You know, I had friends and family come out wanting to buy Bitcoin. Everyone thought that this was the new get-rich-quick scheme. It was everywhere. There's going to come a time that it's going to be everywhere again, and everyone that you know is going to be talking about it. And that is when you can guarantee to yourself that it's not different, okay? It's not different. So the big boys, the whales, these big guys that you keep saying, oh, the whales are moving their money to other exchanges or wallet. I don't really understand that sort of concept. I'm more of a technical analyst, not so much these fundamental guys. The point is that there will come a time that you need to get rid of everything. Get rid of, not everything, get rid of the majority of what you don't want, okay? So the run has come, the run is over, and you're going to get a period where the market is going to come up and crash. So I just want to give you some sound, logical advice. I'm just going to discard all this. We're going to open up the Dow Jones market. Just update our data. We will move it to a weekly bar, and then I just need to change my colors and make it thicker so that I can see it properly. I'm a bit blind now. Okay, so every market crash, let's go through them. And I want you to think to yourself, was this time different? So in 1901, so the market hit a peak and then it fell 50% from 1901 out until 1903. So it spent 2 years in a downward market. You would have thought that the people at that time thought that this time was different, right? This time being different, I mean, from the crashes that occurred in the 1800s. Let's go forward a bit, okay? So let's go from 1906 to 1907. Again, the market fell around 50%. This is the Dow Jones, okay? Now there's big whales, this has your big money managers, you know, all the rich people, they all invest into these markets. Okay, so let's go from 1909 to 1915. Again, I think it was a war around this area, so given that situation, it might be different. But the market fell again around another 50%. Let's go forward in time. Let's go from 1916 to 1917. The market fell 40%. All right, so we're getting a lot of these moves in this sideways action. Let's go forward in time. 1929, the market originally fell 50% before rallying, and then eventually fell 89%. Again, you would have thought that after that scenario of the market, you know, falling 50% each time, that this 90% decline would not have been possible, because the whales, the big boys, they would have protected us, right? They would have bought the dip and we would all be rich in the end of the day. Cool, if that's your hypothesis on way of viewing the market, whatever, I'm just trying to provide you another opinion. Let's go to 1937, we'll go out to this 1942. Market fell roughly 50%. Again, wouldn't you think that after this crash, everyone would have learned their lessons and the market dynamic would have changed and this time was different? If again, okay, let's go from 1946 to out here, 25% decline. Let's take a look at this decline here, 20%, 30%, 30% roughly. This one here was roughly 40%. Again, I believe this is war-torn area. This one was 45%. We're out to 1987 now. This one was 40%. Let's go to 2000, 40%, 50%. And then we had the recent crash of 2020, which was 40%. The point I'm getting at, and I'm hoping making it very clear in this very long-winded way, is that it doesn't matter what you believe, it doesn't matter what you think, it doesn't matter what anyone else around you thinks. The market will do what the market does, and the big boys, yes, the big boys, they would generally sell here, and they will generally buy here. The small boys, that's you, will generally sell here and will generally buy here. Complete opposite, okay? Now that is the case for at least 90% of the people who come into the market near the end of the bull run. So anyone that was coming into the market in 2019, seeing the market reach all-time highs and seeing everything in the news going, this is bull, this is bull, this is bullish. The market crashed, they all freaked out. You get your 10 to 20% of new investors who come into the market seeing an opportunity, maybe first-time investors as well, but the majority of people have already been wiped out before they start entering here. And then you get the first-time investors that might be having like $10,000 in the market that have been waiting for the major crash. Okay, so the majority of the people buy late, while the minority of the people buy early. The point I'm trying to get at is this time is not different, and this time will be the same. And the more different that you think it is, the less different I think it is. So to wrap up this very, very, very long-winded video, the market could be about to push higher, and it could be about to push higher very dramatically. And that is the point in time that you need to start thinking to yourself that this time is not different and that you need to be preparing for your exit strategy, okay? That's very important. The only time that you should not be preparing for an exit strategy is if the market does not push higher. The lower it is, the less likely and the less significance of the decline. And the higher it is, the more likely and the more significant the decline. So if the market does nothing until, December, then the decline could just be like 10-15%. But if the market rages higher into that 150,000 mark and everyone is buying in and everyone thinks that this is the new moon, then that decline is going to be even greater. Okay, so that is how it works, and that's what you need to be looking for the next 2 to 3 months. That's simple as that. Where are we now relative to where were we? That is what's important. So I'll go maybe into more detail in this very concept in the future, but that's just some food for thought for today. With that said, any questions, any comments, like, subscribe, leave a comment. You know what to do. If you didn't like it, it doesn't hurt my feelings to leave a thumbs down. It just lets me know that you didn't enjoy this content, and I'll work on something else next time. Talk to you soon.